Hi, my viewers. Thank you so much for tuning in. We are here today at the Emergence Investment Conference. I have a very special guest here with me today. I'm joined by Dania Zinurova, the portfolio manager at Wilson Asset Management Alternative Asset with ticker WMA. Dania, thank you so much for joining me.
Thank you for having me.
Absolutely. Now, with your remarkable career that is spanning across various regions and roles in real assets investment, including your current position as portfolio manager, could you share what trends that you are observing in the private credit, fund, and property investment landscape, particularly in terms of diversification and risk management strategies?
Sure, that's a very exciting asset class when we talk about private credit. Real estate is a very long-standing strategy, and when we think about wholesale investors, in particular family offices, they've been investing in real estate for a very long time. So private credit is probably something of a new phenomena in the Australian market. It's compared to other markets like the US and Europe, it's probably a less mature market and still growing. So when we think about the opportunities, those are the opportunities in terms of the growth and in terms of accessing different strategies. Because when we talk about private credit, it can include a range of different strategies. It can include corporate lending, it can include distressed special situations, real estate debt, infrastructure debt, asset-backed. There is the whole range of all those strategies, plus the whole range of risk and return of those strategies. And when you look at the Australian market, it really experienced this huge growth in private credit on the back of different factors. Once, while banks in Australia, they're still less restricted from regulatory perspective compared to the European or US banks, they've been lending less. In particular, when we think about the smaller and mid-sized businesses in Australia. And so that opened up an opportunity for private non-bank lenders to come in and participate in this opportunity. It also has been an environment where there was initially a lot of uncertainty around interest rates, and then we all saw that RBA started increasing cash rates. What it means for private credit investors, that means increasing income return, right? Because if we look at private credit returns generally, about 3 years ago, we'd be looking at about 4.5 running yield. Now we look at exactly the same strategies, and I'm talking about plain vanilla, senior loan, private credit strategies, and the yield is between 8 to 9%. So of course it is more attractive for the investors currently. And what's very interesting, given the explosion of all those strategies, I do see that sometimes investors need to spend more time to understand the risk return characteristics of private credit, right? Because if you think about private credit as an asset class or as a strategy, it has limited upside, but it has unlimited downside. And what happens often, you'd see some strategies promising 15 to 20% return, and investors get very excited about this. However, often they miss the downside risk, because for this type of strategies, the whole capital can be wiped out. So risks are significant. That's very important to remember.
Amazing. That's very insightful indeed. Now, given WMA Alternative Assets focus on providing retail investors with exposure to a diverse portfolio, how do you envision the role of private credit evolving over this diversified investment approach?
Look, as I mentioned before, for me, private credit plays quite a specific role in any investment portfolio. It's an asset class or a strategy that is supposed to deliver fairly predictable, fairly stable yield. And different approaches are available. If it's a private credit strategy that focuses predominantly on floating rates, then yes, of course, we will see some fluctuation in the income return. If it's a private credit strategy focused on fixed rates and they are available, then there will be more visibility, more predictability in terms of the income return. So when we look at the portfolio construction and think about what role does it play, first, it's income. It's a yielding asset class. There is no capital growth. And second, it's an asset class that can serve really well as an interest rate hedge. In other words, when there are floating rates within the portfolio and we see RBA further increasing interest rates, then you can expect your income return from private credit will increase in line.
Right. Amazing. Well said. Now, as you navigate the dynamic market environment, can you shed some light on the strategies that are employed by WMA to consistently deliver absolute returns through a combination of dividend yield and capital growth, especially given the current volatility and uncertainty?
The beauty of WMA portfolio, I say beauty because it's like hard to just call it benefit, and I love what I do. The portfolio invests first across all those asset classes, right? I invest in private equity, private credit, real estate, real assets, infrastructure, and the portfolio itself is well diversified. But what it also means for the shareholders who have exposure to WMA, it means they add complementary benefits to their broader investment portfolio. So let's say if you are a retail investor, my guess would be you're very likely to invest predominantly in equities because that's the case for the Australian market. Now, you would want, when you face this uncertainty and volatility in the markets and in the macroeconomic environment, you would want to have in your portfolio strategies that would deliver different returns and that would have different risks. In other words, that's what we call investments with lower or negative correlation to other asset classes. You would want to have strategies in your portfolio that can hedge against interest rate, that can hedge against inflation, that can deliver both income and growth. And you can find all of this in alternative assets. So, for example, asset classes or strategies like infrastructure, they are predominantly yielding. We're talking about assets like airports, toll roads, ports, renewable energy, social infrastructure like prisons and schools. They are all infrastructure. Why they are income yielding? Because we're looking at those assets with very long-term contractual revenues. And often those contractual revenues can be 20, 25, 30 years. So it's quite predictable what to expect from those assets. Plus, those revenues or streams from those revenues, they are linked to inflation. So most of the time, it's a really good inflation hedge. At the same time, of course, you would expect some gradual capital growth from this type of strategies. If you want to add more growth, let's say you expect to take more risk in your portfolio because you look for additional capital returns, then asset classes such as private equity, they would be delivering predominantly capital growth within your portfolio. They won't be yielding. That shouldn't be the expectation. They would have different investment horizon, often 5-7 years. But the expectation is they would deliver those excess returns to your portfolio. Plus, when we think about alternatives, those are long-term investments. So, as an example, we have exposure in our portfolio to Sunshine Coast Airport. It's not that we buy this airport today and then we go and sell it tomorrow. It's a privately owned asset, and we will hold it in the portfolio for a long period of time. So, before making an investment in those asset classes, it's a good exercise to look at the broader economy, to understand what are the drivers of the economic growth. What are the trends that you want to tap in, be it growing aging population, growing demand for food, digitalization, etc. Why? Because if you invest in the asset that is linked to, let's say, growing aging population today, and you are selling this asset in 7 years' time, you want to make sure there will be strong demand for this type of businesses.
Definitely. Those are very key points that you've raised there, Dania. Now, drawing from your extensive experience in senior investment roles globally, what challenges and opportunities do you anticipate for fund managers and investors that are navigating the current landscape?
Challenges. Look, there are always various challenges. I think in the current environment, it's about focusing on quality from the investor's perspective. So having a really good understanding of the risks, understanding how to construct portfolios with a good downside protection, that should be really the focus. Um, from the fund manager's perspective, I think the challenge, at least last year, for many of them was around structural shifts in the Australian market. And I know within your audience, we are talking predominantly about wholesale investors, such as family offices. But broadly in the Australian market, the main source of capital for fund managers used to be super funds. And this source of capital has been drying up gradually, where now they cannot count on super funds to support and to back up their strategies. So it's really finding their feet and using platforms and networks such as yours, where they can connect with family offices, they can understand what family offices need and want from those strategies, and how to really tailor their offerings for wholesale investors. So I think what you're doing here is fantastic. There are not that many businesses that do this. So thank you.
Amazing. Thank you so much, Tanya. Now, before we wrap up our interview for today, we are here today at the Emergence Investment Conference, and you're one of our panelists for a very exciting panel session that's coming up shortly. So, do you have any key takeaways to share, and how's your experience been being here today at the event?
I think it's been great. I found the dynamic really exciting. There is a good entrepreneurial spirit and a good mix of both investors and fund managers. I met some really interesting people who started exciting, innovative businesses. And I think the fact that you have such an engaging audience just says a lot about the quality of your events.
Amazing. Well, thank you so much, Dania. We're
Thank
so
you.
glad that you could join us here today at the event. To our viewers watching, thank you so much for tuning in. I look forward to seeing you all in my next interview. Thanks, Diana.
Thank you.